a good thing, but yeah, sure. I definitely like it for people to be on camera just because I want this to be a fun, interactive type of conversation. And just so like everybody knows, just so they have the context, feel free to completely raise your hand if you want to ask questions. Um, Even if I'm not seeing it or something like that, speak up. I think this is going to be a lot of fun because I think this is something that's very necessary for the industry to understand where we are. So I'll go ahead and get started. And like I say, let's make this interactive. Let's make this fun. Let's talk about it. And just so everybody knows, this is not an attack on any individual. This is not an attack on it. This is just, I think, from my data analysis and everything that I'm seeing throughout the industry and my years of experience, kind of where we need to move forward as an industry. Uh, and that's why it's named the old guard or new guard versus old guard. And just so everybody knows, this has nothing to do with age, because I know people that are old guard that are 60. I know people that are old guard that are 25. So this has more to do with the mindset of how we're going to move forward as an industry that I don't believe has been discussed enough. Because, as I've said many, many times, it seems like everybody still believes a refi boom is around the corner. And as I jokingly call it, I call it the Paul Revere syndrome, because people are constantly telling me every 6 months the refis are coming. And the irony behind that is, and I'll get a little bit into that, is some of the data that really explains what's really going to be happening as an industry and where we're going. And that's, like I said, to be clear, I'm not talking about age. It's about a mindset. And I'm also not talking about people that have been in the industry. There's a reason why they say old habits die hard. Especially where I have a lot of empathy for the industry is essentially from 2003 to 2022. The industry is what I would call kind of like the baseball era was in the PED steroid era. And what I mean by that is it's called for what it is. First, the Fed cutting interest rates, and then the dot-com crash boomed real estate as the next big investment. Then there was a lot of speculation, and then there was a bust. And then in the bust, for 14 years, from starting in 2008 to 2022, there was always some form of, outside of the taper tantrum, some form of quantitative easing, which was the government buying interest rates lower to spur not only refi activity, but really for people to save money and to try to reboot the housing market. And what I can say is it worked really well. It actually did its job. The problem, like anything, is it went too far. So diving into those numbers, it's just something that I'll go over, but I really want to define first what the old guard is. The old guard is a mindset in mortgage. It's dependent on perpetual refi booms fueled by government intervention. Honestly, I understand why. Like I say, heavy government intervention for 20 years. However, it's been over 3 years since the slowdown, and actually, it's really been 4 years. People just didn't feel it. However, the second half of 21 was slower than the first half, and usually the second half historically is a lot more businesses being done because of purchase market and everything. So it was very refi driven. So when people would hear that someday refis are going to run out, nobody ever thought it would. For the most part, it has. I mean, it's still 20-30% of the business. However, some of those are second mortgages that count as refis now that the second mortgage game and HELOCs are back in. And there will be cash out refis just because of the debt loads. However, a boom, what I would call a refi boom, has to be a rate and term boom. It's just not happening with how many people are below what they call loan locked or landlocked, where they may be at 2-3% to buy something so much more expensive. They got it 5-10 years ago when it was a lot less, and here you are. And then it's waiting for the market to save them. That's part of the old guard. Nobody's coming to save you except for yourself. And believing that collaboration is a weakness. I don't have to be sharing all this information. I just believe like it's my oath and my responsibility to get this information out there, because when I travel to conferences, it really does break my heart how many people keep relying on the old business model, and that's really what it is. And things shift. The business model before the financial crash in 2007, when it really started in the industry, 8 was just when it was obvious, when Fannie and Freddie were seized, is different. The business model when I first got in the business is different then, and this is going to be a different one. A lot of things have changed, a lot of data points have changed, and even laws have changed. With the recent trigger lead bill, that's going to change the dynamic and the scope of how people protect their portfolio. And for generating refi, start going after other people's portfolio because they don't have to watch exactly what's going on. And a lot of that is just resting on past successes. I know that 2020 and 2021 were incredible years. However, that's was an anomaly that you don't really see. Again, 14 million units back-to-back years, and now we're at 5 to 6 million units, even as low as 4.3 million units in 2023. And the lesson here is that old guard thinking leads to stagnation of your business, and it's going to be different how to grow your business because the dynamic that's also thrown in the mix is inventories in an all-time low. Yet we have also the highest demographics of first-time home buyer and second-time home buyer from what was a baby boom in the millennial, and even into now the early Zs. And you're also seeing Zs that are buying a lot more homes sooner. So the positive is that we have a lot of runway. We have a lot of opportunity in the industry. It's just the opportunity is not going to be massive where anybody, not anybody, but for the most part, a lot of people can have success. And I'd like to open it up. Any questions? Anybody want to ask me a question before we go on to the new guard mindset?
When you mentioned conferences and the old structures going away, can you give me an example or two of what we want to stay away from, or what would be new guard and new guard action versus the old guard action?
Um, and a structure, I'm meaning more of the mindset and the data behind it. I think conferences are still going to be popular. They're still going to be outgoing. It's still a great time to see people, meet with people, and strategically plan. I think the strategic plan is going to change. And what I firmly believe is anybody who thinks rate and term refis in particular are coming, the data's not there. It's just, I forgot the stats. I saw them 70 or 80% of people are below 6%. And we're at that. I'm not saying that refis can't happen. What I'm trying to say is it's not enough. And what people have to be very honest with themselves is it's the consumer direct companies, the big ones, and even the medium ones that are going to get most of that business because that is more of a call center type of business. The consumer doesn't care if you're down the street, doesn't care if it's a real estate agent, doesn't care if it's even a friend. If anything, they don't want to get financially intimate, I would say, with somebody that they do know on the second go around because they may feel shame or, you've seen the commercials out there where people say when banks compete, you win and you got to do this. And Chat GPT is also helping in that arena. So I just believe that cash outs are definitely going to happen with debt loads at 1.2 trillion and something like 35 trillion in equity. However, it's not going to just be, and mind you, if this was 10, 12 years ago when home equity lines didn't exist after the crash, I'd tell you there'd be a lot more cash out refis. However, there's still a lot of people that can do their debt consolidation without having to refi their first, unless they've really destroyed their credit and they're left with no choice. However, I just think that to avoid it is just making sure that anybody's business model in here, anybody's desire is not to be on rate and terms because as I heard a long time ago with rate and terms, they cometh and goeth very, very fast at lightning speed because here's the other part. Most of it is a paper generated business when there are those rate and terms. And a lot of those people with a paper have very low interest rates unless they already bought new ones. However, to make a benefit for them, you're going to need at least a 1 to 2% drop in their interest rate, or if they now have more equity and they can get out of PMI. So that's just not a very sustainable model. And like I say is you have to understand the consumer direct channels that have some of the greatest data already are mining and going after that. So you're up against a very formidable opponent who I came from that industry alone at first when I first got in the business. And they are, like I say, they're assassins. They're so good on the phone and they stay in front of the people. And a lot of originators don't stay in front of the people. So it's not like those people are going to have loyalty to you. So that's what I would say is anybody thinking rate and terms, or I remember hearing survive till 25 and now there's a new one about 26. I think you will keep hearing these stories. Not because I think people are evil or mad or manipulative. I just think that they're believing hope is a strategy and hope is not a strategy. You should always have hope in life. However, it's not a strategy. Mel Robbins always quotes, nobody's coming to save you except for yourself. And that's true. So, any other questions? Cool. All right. On to the new guard. The biggest thing is the edge is going to be adaptability, embracing change, tech, AI. And let me get into this old guard mindset. Everybody gets into the, oh my God, I need to preserve jobs. I need to preserve jobs. I need to preserve jobs. I would tell you when it comes to tech AI that you need to follow kind of what I would call is the bisons versus cows. Bisons and cows can both sense a storm's coming. The difference is the cow starts running and tries to run away from it, and the bison goes in it and takes on the fear first and foremost. And once they're past that fear, they're through the storm quicker. The cow keeps running, 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 gets tired, it catches up, keeps running. So it's like a perpetual race. AI, it's not that it's going to replace humans. AI is a learning and development tool. It's going to merge somebody's skills, a person's skills, and tech and mirror it to be more flow. And the reason that's needed is because of how much regulatory business that we have. I mean, we've been able to roll out bots here that took out the mundane data entry and some of the stuff that people are having to recheck to check that stresses them out anyway. That's now off their plate. Now, do I think some of the people that probably do not take this industry very serious and the trillions of dollars we move and what we do I think that maybe some of the people that are kind of burned out, yeah, they may leave the industry. I do believe there will be less jobs, but only because I think efficiency and effectiveness will be higher. However, medium to top performers are not going to lose their job. They're always going to have a place to be. It's going to be for the performers, for whatever reason, they may have been a top one. They may be resting on their laurels. They may be thinking that it's going to come a certain way. So really leaning into that is what's going to really take people. And that's everything. That's even in sales and not just a CRM. There is some really, really great AI out there that really can help even wording things and phrasing things better for you. And then, yeah, the other one is seeing today's market. This isn't a crisis. This is a gift. Um, Now, some behaviors that are out there may not be gifts, but this is a gift and an opportunity or heavy purchase. That's not a bad thing. That means the first-time home buyer, second-time home buyers creating a lot of wealth, and they're starting that process. A lot of the loans are first-time home buyers. That's going to help a lot of minorities. You keep seeing that the biggest first-time home buyer is the Latino market. You've seen that grow in Black Americans. You've seen that grow with even single moms as first-time home buyers that are providing for their kids, and that's a huge positive when. I mean, I wouldn't call it the underserved market. I know that's what they call it. I'd say it's more of new entrants into the market. And I think that's a very positive place to be because as we've seen, real estate is the greatest wealth generator through history. Like I said, there's 35 trillion in equity alone. And that doesn't even include the debt markets that also support the industry and supports businesses with servicing and servicing rights. That's at another, I think, 14 trillion. So you're talking about it's a 50 trillion net effect, which is kind of bonkers to think about, just absolutely bonkers in a positive way. And that's one of the big things is that part. And then now there'll always be transactional business, but now is when relationships really matter. Realtors, financial planners, builders, even, one that is just part of the ecosystem that a lot of people don't want to tackle is divorce. Divorce happens $1 million to $2 million a year. It is a part of life. Transactions are over 50% of it. And divorce attorneys are more than happy to refer that business because they're trying to find a solution for their client. And sometimes you even get it on both sides of the equation or you get a cash out. I've known people that do 15, 20 loans a month. Now they have a very large network throughout the country of divorce attorneys. However, that's not a negative. I think that's a positive. That's just a part of life that I think people need to really understand that. And at the end, that loyalty isn't just given. You have to constantly be adding value and delivering results. And the lesson really for the new guard is it thrives and it invests in growth, adapts, and leads with value. Not just character, but what is the value that they're able to drive? If your value is just my rates are better, my fees are better, I'm not saying those aren't important. However, time and time again, anybody that's been in sales in this industry has lost deals to somebody who just made the other person made them feel better. And they didn't care if they were an eighth more or a quarter more because it was only 20, $30 on their payment, and they just didn't care. They felt more at home, or their real estate agent that they trusted referred them. That's just the name of the game, and you have to understand that. Because if that wasn't the case, then I mean, there is a piece of the industry that has been commoditized. Don't get me wrong, but what hasn't been commoditized yet, and I don't think will, because that's where people want value, is that first and second time home buyer, because they're only putting 3.5% down, 5% down, 10% down. I think once somebody's putting down 20%, that's a whole different market. They have 9,000 people coming after them, and I don't know the number. I'm just saying that facetiously out there. Questions on the new guard? Anybody have questions they'd like to ask?
Eddie, there was a comment from Marcus just sharing some data. Maybe you want,
Okay.
if you want to look at that
Okay.
and
Where is
some
it?
perspective on what he showed. I don't know if Marcus, you want to come off mic or
Yeah, if you can come off mic, that'd be even better because I'm trying to find it here.
he said great data on refinance trends and potential in ICE
Ah,
mortgage monitor report. Do you see that?
On pages 8 through 12, example average rate change for cash out refis in 2025 was 1.5 existing note rate to cash out. Average equity withdrawn, cash out tapped was 94,000. 52% of that refis were. Yeah, I mean, I'm not surprised. And if you throw in there at times, Marcus, the second mortgage that they may not consider a refi, but it is cash getting pulled out, from what the data I've seen, the numbers even go higher. I think the rate and terms are just a very small piece of refis right now as a whole account for about a third of loans, maybe a little bit more given on the month. However, two-thirds are purchase. So yeah, and it's great to hear from you, Marcus. He and I were in Future Leaders, God, 12 years ago. I don't want to
Yeah, forever
date
ago.
ourselves. I don't want to date ourselves, but that's when we were in Future Leaders at the MBA, which was a phenomenal program. That coincidentally, I'm not surprised that Marcus has a lot of this data, because I do too, because a lot of this is provided by the Mortgage Bankers Association. Is it 100% accurate? No, because things happen in the wind, but their data is usually so spot on and so close that all you can do is use that barometer, things like that.
Hey guys, Eddie, I'm sorry.
No, go ahead.
I, I, I run a big marketing company for the mortgage industry, and I have all the data. If you guys would like to see it, I'd be happy to show it to you. We ingest the entire CoreLogic database daily, updates, edits, and appends. And what we do is we monitor what's happening in the market on a week over week basis. Even though it's slightly skewed because of how loans come in and out of a database. But I can show you, I mean, the biggest trend right now, believe it or not, is uh, rate and term in conventional space. And well, besides that, it's 70/30 purchase to refinance, number one. And then it's about 65% tilted, almost 70% to conventional, believe it or not. And then one of the biggest trends I've seen, which is flies in the face of a lot of what even my clients think, is that the refis are being done in Govy space.
Well,
The
Govey's easier to your point
Yeah,
because
it's
it's
easier,
more
but
streamlined overall.
the
Conventional.
just the quantity of rate and term refis. If you like, I'm happy to share with everybody. I have a
Yeah,
dashboard.
yeah. Share it out there because that's good news. I don't think people are really going after that business.
Yeah, I don't know
Usually,
how
it's
to
more than likely
I'm gonna share it.
you're probably providing that data to a lot of consumer direct channels. So more than likely,
Yeah,
it's
a
direct.
lot of people that are in the refi space.
Yeah,
Uh,
it's the refi space that's grabbing it up, and I think that would be good for the street LO, I guess, as they call
Yeah,
it.
I think one of the things to consider is like what we realized is that about 65% of all rate and term refis are actually term reductions, which is really strange because these people that were kind of in these loans for the last couple of years, they've gotten higher interest rates since late 22, right? And those people are, you know, viable rate and term. But what interests people, I think, more than just saving $100 a month on their mortgage, which most people come at them with, is actually being able to cut the term of their mortgage. And with odd year mortgage terms out there, it's just something to consider. Keep in the back of your mind when you're talking to somebody. The value prop for a lot of these people isn't necessarily in the conventional space saving $100 a month. It's about cutting 3 or 4 or 5 years off the term.
Yeah, it's cutting off the overall interest. And that
Yeah.
doesn't surprise me, especially on the A paper sound, because they're usually in a much better financial position than the first and second time home buyer. A lot of time they're the third or fourth time home buyer. And I'm sure you're also seeing it where loan amounts are even larger because then, you move a lower term, you move by even a 1% rate. The old rule that you had to move the rate down by 2 made sense when it was smaller loan amounts. But now with loan amounts, what they've done, 1% depending on the area. And obviously, if closing costs aren't crazy, some states are, some states are not. I'm sure those are all the factors to your point, Ken, that really play into that. But I'm glad that you refreshed some of the the rate and term opportunities, because like I say, that's usually any refis that really do happen outside of IRRRLs, because even the FHA streamlines because of how they have to qualify and they can't wrap the whole cost in like the IRRRL, does change so much of that markability compared to, the IRRRL. You can streamline
Yeah.
and wrap in the costs, and when it comes to conventional, you can do the same as long as it makes sense for them. They're also the consumers that when they save a payment, they sometimes will bring that to the table for closing costs because they don't care about skipping a payment. It doesn't matter to them as much as less closing costs, less loan amount. So that's great data. And yeah, if you want to share it.
The reason I bring why it's an actual dashboard built into a BI tool, so I can't just blast it out. But maybe I can get a, a, a snapshot of it and send it to you guys. Put it in this. Put it in here. I'll try.
Or if you want to put in the chat your contact information, if people want to contact you, then
Yeah, I mean the reason I brought that up is I'm a firm believer. If you believe you can and believe you can't, either way you're right. And so, like many of you guys that are doing, uh, you have a book of business over many, many years. Don't think that you can't go through the book of business and do refis because companies that I work with are attacking those people and getting those refis.
cool. Well, thank you for that.
Sure.
And then, the next is, mortgage industry application. There's an old saying by Warren Buffett, when the tide goes out, you'll see who's swimming without shorts on. And I think that's one of the things that really happened in the industry was, unless you were in the business pre-2003, and I had only been in the business in full disclosure about a year and a half, you have perpetually, there was something like 8 or 9 refi booms in a 19-20 year period. And refi booms lasted at least 6 months, some even 18. So essentially, pretty much for 19 years, we were in a perpetual refi boom one way or another. And it's not that it just generated bad behavior. You have to also think about what was going on. Margins were very thick. That's the other thing that's changed. It's not just that units are down, 14 million to 5. It's also that revenue per loan is down, while at the same token, costs have gone up. Now, the question is, why have costs gone up? I think after the regulation bill, a lot more staff was needed. I think that staff reductions now coming because of tech and AI. And I don't think that's a terrible thing because the consumer, just to put it in perspective, the numbers have gone up like 300%. So the law that was meant to make things less expensive and to protect the consumer has done nothing but make it more expensive. And obviously, it's always a very controversial subject. I've never had a problem talking about controversial things. Some people felt like it protected the consumer. I do believe there were parts of it that were great, but I also believe there's parts of it that wasn't great for the industry. I don't believe some of the rules in the servicing law are great because a consumer, you're seeing an explosion in defaults. And it's because anytime there's a storm out there, they get a letter from their servicer that's required that you don't have to pay the mortgage for 90 days. So what do people go out and do? They blow it. And then what do you think triggers defaults? But because we opened up Pandora's box with forbearance, they now really don't care because I've heard the calls. I've seen them. They get a letter when why are first payment defaults going up? That servicing law says if for the first 60 days your payment doesn't get received, you won't be marked as late. So what do people go do? They go blow 30 to 60 days and then they perpetually get late on the first payment. I think this is unfortunately like the unintended consequences of everything. This is what has generated really, really poor habits, which obviously drive poor behavior. And yet the industry, I'm not sure, is really ready for higher defaults, even though I don't know if foreclosures are a horrible thing. And what I mean by that is I'm sure everybody here knows that we've got a little bit of an inventory challenge. Doesn't everybody agree? This would add inventory. And the great news for the bondholders, even the FHA insuring and everybody, is they can really sell their house if they want to now. I mean, yeah, maybe they can't get the numbers that were in 22, 23, but it's like one of those things. If you've made 3x, but now you're making, say, 2.5x above what you bought it for, that's not really a horrible day for you. So I believe firmly when it comes to industry application is understanding a lot of these rules and regs and how they really affected the industry. So there needs to be correction done. Would I like to see changes on that servicing law? Yeah, but I'm not 100% sure of that. I think it takes congressional approval, and look at how hard it was to get the trigger lead bill done. I highly doubt this will change anything. I just hope the bureaucracy of this country increases the thresholds instead of holding it against companies that underwrote the loan great. Another exploding problem is who's in Florida here? Just for fun. I like fun. I like interacting with people. How much do you think over the last 4 years taxes and insurance have increased on the PITI of mortgages? Just the tax and insurance. Anybody want to take a stab at it?
200%.
Yeah.
Lower.
No. Who said 200%?
Me.
Did you say higher, Steve?
Yeah, I have a house in Destin, and it is almost 4 times as much as it was in 2008.
So
2016.
to let you guys know, depending on the factors, it's anywhere from 200 to 400%. So when you're seeing defaults in Central Florida, who's had some of the highest appreciation, and Jacksonville, not Miami and South Florida as much, and not the Panhandle, even though, yeah, you're getting destined because you're probably getting crushed with insurance. Now that just has gone up because of hurricanes that have hit. So think about that. You're a 40% DTI and you may be a 60 now. That doesn't mean there's poor underwriting. That just means the dreaded word, inflation. And nobody wants to talk about it. And it's legit because, unless there is a value crash, which I don't see happening, just because demographics are still very strong. It may be unaffordable, but it's unaffordable to some people, but not to all. But yeah, that's, Alan, I really wish it was only 80%. I don't think we'd see as many defaults as we're seeing out of those areas. Sadly, I see that with a lot of sadness.
Depends on the period that you look at, right?
Yeah, but a lot of these loans, they're starting to default and they're not understanding, you have regulators and bureaucrats saying, I don't get it. I don't get it because obviously after the financial crash, my property bill actually went down, for people that remember that. And if property taxes have gone up, and it's not even property tax, Florida, it's like insurance has gone up like 400. It's something clinically bananas. So if it's done that, of course, PITI has been affected. Even if people have made the same, even if they're doing well at work and they got a few raises, it still can't keep up with it. So that's where I say industry application is crucial. And the lesson is we got to start understanding the playbook better and understanding how to get out in front of things. And even how an industry, how we can advocate in front of these things, because I do believe it's going to affect great organizations. I think there will be stigmas put on them. I think things will be vastly inaccurate because these are things so out of your control, it's not even funny. But having dealt with it myself, red tape is red tape. And Travis, I remember you went through future leaders training yourself. This is so much of the advocacy things that we're taught about to be very, very aware. Because it's never one moving part. It's like, I don't know, 5, 10, 20, whatever we want to make up. But yeah, that's, you got to understand what's today. And man, I heard something last week from my president. This week from my president, Phil Mancuso, that he said he had a friend because he lives in that area, so he's seen the explosion. That he knew a lady that he had been talking to at, I don't know if she's a golf pro or one of those. She's leaving Florida because it's too expensive. When Florida 10, 15 years ago is where you went to save money, not just taxes. Like, it was actually quite affordable to buy houses there, kind of like Atlanta, where I'm at, Georgia. Now, Georgia still hasn't had the same inflation rates. However, Florida is now, I don't know, the new place to be. So that has exploded the expenses because, once again, high demand, not enough supply. What is that going to do? What is that going to do? Raise expenses.
Yep.
Questions on application? And now for the tough part. Leadership and culture. And what is culture? Culture is culture is an outcome of strategy, vision, and execution. That's what culture is, because you've created an environment, a land that allows for all those to thrive. A culture also has to have meritocracy, where it's not box checking. The people that win are the most qualified, regardless of just pure meritocracy. A lot of times when you follow culture, there's always meritocracy, and the people that are getting promoted or the people that are rising up are given a fair opportunity and a just opportunity. But yeah, that's going to be the tough part, because what I've already seen is what I like to say is inheriting the ghost of leaders past. Every leader, every person on here will have to inherit it, where I'm sure y'all have heard it. Oh, we used to do this at my company. Well, then why aren't you there? And oh, nobody else is doing this. Well, if everybody else was jumping off if everybody was skydiving without a parachute, would you do that too? So a lot of that is what I say, old guard thinking. And there is a certain sense of responsibility that I think has to be put in place, because it's not just you have political risk, is what I tell people. And what I mean by political risk is, if you're not putting a certain guideline update or even a pricing hit to certain risk factors, then you can't even demonstrate, if you are asked, like, hey, why is this going on? What did you do to remedy it? That you did this to make sure that you have more liquidity and you can handle things like that. So they'll say you're irresponsible versus you're responsible. And that's why I say leadership is really hard right now. And I say this with a lot of grace and humility, even though some people will view it as controversial or upsetting. I think 50 to 100,000 people in the industry, probably to a degree, got to go. Because not only can it be replaced by tech and automation and AI, I don't know if they really want to be here. And I get it. It's gotten really, really tough the last few years. However, I hate the phrase new norm. I mean, that literally makes me want to vomit. I want to vomit right now saying it, just to be honest with you guys. What I will say is, it's just the market. None of us control the macro. The macro is the macro. All you can control is your micro, your four walls. And, having radical candor, having courage, having mutual respect is non-negotiable. That is the respect and candor you have to have with your team. Even if they tell you their friend down the street doesn't have to deal with that. I've been fortunate enough to be in enough rooms, sat at enough tables, and been graced by so many great leaders that have poured into me that didn't even have anything to do with me, that really demonstrated this collaboration, even though we were quote unquote competition, but there was a love for the game and a love for the industry, because there's plenty to go around. That zero-sum game, that there ain't enough business, that's just for the people that want to annihilate, not work hard and really make value, that they just want it to rein in and follow them. So yeah, the lesson is for leaders to unify through collaboration, to show the way, to struggle well. And that culture is a competitive advantage. However, you can't have it if you don't have strategy, vision, and execution. And a lot of times when you don't have that, is just because you lose focus. And I get it. There's bullets that fly everywhere, all over the place. There's stuff that always shows up on people's plate. There's drama, there's this, there's that. And, that's a part of it. That's the really tough part, is because bad behavior was not only rewarded, it was encouraged and overpaid for an awfully long time. But I can tell you from somebody that did do capital markets, servicing is now being watched. So the days of people putting a 6-8 multiple are gone. So they can't cook their books with that. They can't borrow against it and cook their books. MBSs, I haven't pulled them up, but, they're maybe at 102, 103 at best. So the days of 106, 108 straight off the bond. What a lot of people don't know is we brought this mess upon ourselves because the perpetual refi booms and the churning is what led to this. It's why servicing on on VA isn't as good, like Ken was mentioning about VA and the IRRRLs, because the churn rate is so high. And the churn rate, as crazy it is, sometimes isn't for somebody to save more than half a point. They want to skip the 1 or 2 payments depending on when you define it. So we did this to ourselves. And I know that everybody will always tell me that they didn't do it. But somehow, everywhere I meet, nobody did it. But then somehow it was done. And I get it. Some of the consumers are really pushing it. So responsibility also falls on the consumer themselves that a lot of people don't want to talk about. So, freedom is everything. Freedom in business, freedom from making sure you have discipline, consistency, as well as ownership. But that's the really, really tough part. And what I really feel for every leader is having to make those tough decisions, and people have to keep working and producing. For a long time, this was not a results-driven business. It was an order taker, let me just follow my lap and get it done. Not anymore. And I don't see a refi boom and 8-9 million units showing up anytime soon. Now, obviously, what I have to preface that, and that's not a cop-out political answer, is if a black swan event happens and the Fed shows up to do quantitative easing to buy interest rates, that could happen. I think that would be more like World War III. So let's really not hope that happens. Because unlike 2008, I think our debt levels were only 12 trillion, somewhere around there. And debt levels of this country are at 36 trillion now. We're now, over this time period, the first time over 100% GDP to debt levels. We could have made all that quantitative easing decisions when debt levels were real low. So that's another 10,000 pound gorilla in the making. That may not allow it because guess what quantitative easing does? Raises inflation. And what is everybody trying to fight off today? Inflation. So they need quantitative tightening. Only problem is, the Fed actually did a really good job quantitative tightening. Problem is, Congress is spending like drunken sailors again. Not that they always haven't. The money supply, which is what triggers inflation, literally, since COVID, increased by 42%. So all the money, all these years. So just to put in perspective, it was more than this, but just to put in perspective for easy math for people to get the logic. If the money supply was 10 trillion, which was obviously a lot more, I'm just using that as an example. Overnight, pretty much 4.2 trillion got added to it. That's what we face. And I think this is where people have to be very radically candid with everybody. Because at the end, I always say this as a leader, if you've expressed it, you've had candor about it, you put wheels in motion, you've made the tough decisions. Yeah, a lot of people will not stay on your train. That just is what it is, guys. It just is what it is. And I get it. I'm not saying it's fun. I'm not saying this is a party. I'm just saying this is the rules to the game. Okay. One of my favorite, Marcus or something. Leadership is responsibility and nobody wants to take accountability. I love how you're being honest about this. Yeah, it's really ownership. To your point, Rachel, you got to take ownership. Because everybody, even if you've done a wrong or made a mistake, when somebody takes ownership and takes action to improve, they've made amends. Everybody can respect that. Marcus wrote, one of my favorite definitions of culture. Culture is defined by the behaviors you tolerate rather than the ideals you profess. Yeah. Oh, yeah. I wore this on purpose. Talk really is cheap. Action is everything. You have to go live it. You have to go be a part of it. And even if you say the words and then don't live up to it, you have to own it, not try to throw mascara, makeup, lipstick on a pig, all those sayings, Botox on it. Nothing wrong with that. I'm just saying is don't throw some of that shenanigan on it. People can appreciate it if you have to own it. Say, hey, man, I gave it a shot and I struck out. I mean, leadership really is like baseball, dude. You're going to go 3 for 10 at best. Sucks. Sometimes you make great plays. Doesn't mean you didn't hit the ball. It just means it didn't work out exactly and you got to make adjustments, and that's perfectly okay. Marco Rowe, what do you think will happen should the GSEs are privatized, and do you think that non-QM business being at approximately 8.3 of the total production per OB would grow more or not? Yes, I think non-QM is going to grow just because that's private capital and that's what they're trying to get more into the market. Essentially after the financial crash and all the private market left, we as an industry, I'm not really an independent mortgage banker. I am a government contractor for housing finance because everything was Fannie, Freddie, Ginnie Mae, which was all either government conservatorship or government agency. The GSEs became more government agencies, not government sponsored agencies. And do I think they go privatize? From what I'm reading, there'll be something that's done. I don't know a full-blown privatization, but there will be something that's getting done. I just don't know if or when, and obviously that could change if the House or the Senate flip back Democrat. That could change too. That's the variable that we don't know, that we don't have. And as crazy as it sounds, because I just know that election years are very painful, especially when they're presidential. So I'm trying to not have PTSD on this, but the text messages have already started about 26. I don't know about you guys, but I get way too many text messages from everybody. It doesn't matter what political affiliation. Somehow my phone is all over the place and I get hit with all this shit. So that's part of it too. And then, you have audio issues. I think non-QM grows because more and more are not going to fit in the box. So I definitely believe that. Plus the gig economy, how much people have 5, 7, 8 jobs differently. I think that's definitely going to influence that. As well as you're seeing a higher population of continuously Latinos buying homes, and they have so many different income sources and different ways to bring it that I think that the product will. The only way it wouldn't is if, Fannie, Freddie, and Ginnie allowed cash flow bank statements to count as income. And I don't see that happening. So I say that stays private capital, which is probably better anyway. And right now, interest rates, the private capital interest rates, there's not a huge swing like there used to be. Is leadership in the industry open to change, innovation, adapt technology, and make the tough decisions? I see procrastination to change and fear of AI. Malin, you are absolutely correct. But that's why you guys are on here, because I believe that you leaders can do it. I believe that even if it's just because I know Fided's on here and he has a team and he does stuff, even if he does it in a small bucket, eventually it will grow. And it's the conversations you have. Now, here's what I'll tell you. The reason why leadership is concerned because they believe there will be mutiny on their hands. But here's what I'm going to tell you. Some insider information. A lot of the largest players are moving to that, as well as moving to offshoring a lot of jobs out of this country. Because why? Costs have exploded. And Fidel knows it. Isn't all your processing in the Philippines?
Not processing, but our back office.
A lot of processing, a lot of jobs are moving over there. Because also culturally, I firmly believe 2021 was the worst for operations. They made so much money that now going back to 2019 income, they just can't even wrap their head around, even though revenue's down 70%. Like they just sales to a degree. And look, I'm a sales guy, so I can kind of call my people out. They at times can run a little delusional, but they don't stay in that space. They're like, all right, this is what I got to do. For whatever reason, operations folks have not left that mindset.
I mean, I remember Citi, Bank of America, Chase, all those people have overseas underwriting and closing level compliance side of things. All of them do.
That's going to keep growing because what happened is, to your point, a lot of leaders were hesitant. They're not hesitant anymore. But they're not hesitant, not even for the expense. It's not even for an expense. They're tired of the culture hits. They're tired of people not doing their job operationally. They're tired of, I hate to say it, the lack of gratitude, because that's what they said. This isn't me putting words in mouths. And look, I get it. And I'm not saying that that's everybody, but I'd say that's probably 80%. I wouldn't say it's 80. It's the whole 80-20 rule. And that scares a lot of people, but this train's not stopping because it was 3 of the top 15 largest lenders in this country that are making these moves. And some have already done it. I leave out names. I'm just telling you what is coming as a leader, and you have to, I mean, I wouldn't even say innovation, tech, and I mean, it's tech, AI, and offshoring. And now the excuse was the English was improper. Well, a little wild thing I just learned. There is now tech that does accent neutralization. So these people with accents can now talk like you and I. So that
I still have an accent.
Huh?
I still have an accent.
Yeah, but I guarantee if you put on that arrest, whatever, the accent neutralization, you'll sound like me.
Yeah, no, I know what you mean.
And look, the only accent I have is in Spanish because even though that is my first language, yes, I am 100% Cuban. And yes, everybody that spoke to me in Spanish till I got to grade school was Cuban. So yes, I have a Cuban accent in Spanish. But in English, since I grew up in the city and I supposedly learned it the right way, because I didn't know English till I got to grade school, and I did not get taught, luckily, by my family who did not have great English because obviously they got here when they were older. Yeah, but I'm telling you, Alan, you can neutralize it now because I just heard it. I heard somebody's language, and then I heard afterwards, and I was like, holy shit. So that's even, to your point, Malin, what is revolutionizing the excuse that used to be language barrier, which it was all bullshit, to be honest with you. It was just people didn't want to. And I get it. It's not like you wake up every day going, oh my God, I want to cut jobs. But you're not really cutting jobs. You are just moving them somewhere else where there's more gratitude and appreciation. That's just the reality, the reframe that's got to be done in this industry is that the old guard is holding on. And there's just certain things you got to let go. Even though, like I say, it's going to be scary, but you have to be like the bison. Once you're past that initial fear, it's never really that bad. It's like a saying I heard, and I don't know how true this is, but I heard it as a kid, but I understand the logic behind it. 90% of what you worry about never happens, and what it does, you can usually deal with it. So, do you feel like there's any chance at LO Compros? God, I wish, Ian. I swear to God. In my morning ritual meditation and prayer and a few things that I do, I'm going to add that to it because the LO comp rules have not worked. They're trash. They're garbage. They're trash. That's part of what made the expense explode. Because now on everything, you had to have a fixed cost and people couldn't negotiate. And I actually think percentages was better, but you can thank Barney Frank for that. He thought that that's what led to greed. I just think poor underwriting standards led to greed. So that's been fixed. I mean, because even FHA has that supplemental that shows that if you do the tougher loans, you have to be below a certain threshold, but that's still market that needs to be created and it's doing well. So that even has adjusters in there perfectly. So yeah, it's just, I mean, look, Ian, from what I have been told is that is on the docket of the administration. I don't know. I don't know if it gets done. Because here's what I can tell you. The CFPB didn't even care when the bad actors after the crash broke all the rules. I mean, nobody wants to talk about it, but on the retail side, there was an article that was written about it, so I'm not talking about. But there's the bucket game, as they called it, which I didn't know what the hell the bucket game is. But essentially what happened is to compete on pricing, and I know this because I know Dodd-Frank really well, you can create 3 buckets of pricing. So what happens is, even though if it was self-generated comp, and it was, we'll just say 100 basis points, but they needed to give up 50, but then branch referral or lead generated was 50. That's how they did it. They played the bucket game. So look, people even found loopholes, even though it's not technically legal, but people still did it. And they're going to keep doing it because there was no enforcement. It's kind of like the Wild West.
I think most companies are doing it.
Huh?
I think most companies are doing it today.
Oh, yeah. It's not being done on the wholesale side because they can just go, they have an advantage because they either go lender paid or borrower paid. So they're doing it just legally and switching it to borrower paid. That's the irony behind it. But once again, laws that create advantages and disadvantages without even understanding it. You talk about wholesale growth and EPM's bold move. I don't know, Rogelio, I appreciate the bold move comment. There's a great article I put out, if you can find it, called Originator Syndrome. Having been an originator, consumer direct, street LO, building my own, when my dad introduced me to builders, even divorce attorneys, having seen how every lead is generated, been a part of it and ran teams, even P&L retail, kind of that net branching, even corporate retail. I kind of learned a basis after thousands of originators I've dealt with. Most originators want to hit a certain number and they want to do the least amount of work to hit that number. And the wholesale channel gives them that flexibility more. Now, they do have to be more responsible. Where retail thrives is for the originator that wants to turn in his file and walk away. So I would say it's more of a personality. Like, you will be more responsible, but you can make more, and it is a little bit more flexible for you to be able to shop with 10, 15. I wouldn't recommend that. I think if you're pricing out with 5 or 7, you can usually get there or get within. And then I would just tell you, if you're comfortable and they're always delivering service for you, to then just go and do more of a, bar paid or something like that. I just think it's really just, at the end of the day, the originators drive this business. Nobody wants to admit that. They do. AEs are just B2B loan officers, and then you got B2C loan officers that could be consumer direct or anything of that nature. They drive the business. They're going to want flexibility. They're going to want options. I mean, hell, you can't get on Amazon now and buy something where they don't tell you 5 different places and you deliver if you want it quicker or you want to wait $2 more. BestX is here to stay. You can BestX shoes, for God's sakes. You can look up a certain Nike and have 5 people bid on it and you get whoever you want. That's not going away. You mentioned the consumer direct model and their prominence in our industry today. How do you see the traditional MLO pivoting to compete against this model to begin being relevant? Travis, it's actually pretty simple. Simple. I didn't say easy. Let me refrain simple versus easy. I have seen originators that stay in front of their book, even call, not a drip campaign crap, call, text, their whole database. And they set up a very ruthless schedule to do this they do it in an hour or 2 every day. To follow up with past clients, miracle. When they get a consumer direct letter in the mail or they get phone calls or their servicer reaches out, miracle. They reach back out to them. Miracle. That just requires a lot of consistency and discipline. And that's what's lacking.
Yep.
But
no different than when you coach our AEs to be in front of their customers and do regular wellness checks, health checks like that. And that's where I find the struggle at the sales side is getting loan officers to embrace that. They've been so transactional over the last 15 years and just taking the business that comes in over the phone or walks in the door, getting them to go back and reinvent themselves to a point where they're actually be more consultants and staying in front of them well past the closing date seems to be a method. It's a mindset issue that getting them to overcome that hurdle. So I think I agree with you, though. They need to get entrenched in that habit in order to make it work for them.
Consistency, that's it.
Yeah.
And you're not going to catch everybody. Maybe they didn't like you. I hate to say that to people. Maybe they didn't like one thing you said, or maybe, I don't know, even though you didn't pick the title agent said something dumb and they want to blame you for it and they don't ever want to do business with you again. That does happen. It's, but it's just staying and just hearing how people are doing, just being engaging, and telling people like, hey, would you like a second mortgage? Would you like cash out? You don't have to guilt them into being like, because you should never guilt people because that creates shame and then that creates anger. Hey, did you have any debts you want to pay off? Because debt levels are really high. Like, it is okay to stay in front. But yeah, that's it. I mean, basically, what I'm saying here and what you're saying, Travis, is don't treat people like a number.
Yep.
If you're doing 5 to 10 loans, and I don't care if you've done 10 loans, 120, you can text 120 people a month.
Mm-hmm.
You can call, 20 days in it, you can call 6 people a day.
Yeah.
You can do this one. This is even more of a cheat code. I forgot. I'm glad you jogged my memory by saying this. If you do a video text, a selfie video text, saying, hey, Travis, think about you, and text it out. I didn't realize how magical that was till there was a guy that came to my CEO peer group and made us do it to 3 random people. And then the reaction was out of this world. I didn't even, one person videoed me back crying, going, you have no idea what this meant to me. And I was like, holy shit, this is powerful. You can do 120 video texts. I promise you. I don't like selfies. I'm going to be candid, but I can do selfie videos.
Sure.
And then last question, how do you see the elimination trigger leads affecting our business? Well, here's what I'll tell you, Bernie, because it's already been said. The big boys now, because they don't have to protect their book as much, they're now going to start direct marketing to get other people's books. So that is going to be an adjustment that anybody with a servicing book is going to have a retention team and defend it. And they can't just give it back to their originator, let it be a broker or LO. They don't have time. Some big people with very powerful muscles are now coming after that because they don't have to watch it as much. I hate to say it, it empowered the big boy with big portfolios to go after other people's portfolios. That's where I think you see the biggest one. Because why wouldn't they? I don't even knock them. You can't even be mad about that. Because the triggers needed to go away, guys. It was horrible. It was horrendous. It was trash.
Big boys still get triggers.
Yeah, because
Servicing and retention, they can still get triggers.
Yeah, because it's their own book. Absolutely.
What they've done is they're just
Okay.
owning the top of funnel. That's why these guys are buying Redfin and other things. They're trying to own the consumer from beginning to end.
Well, what they're also going to do is buy the data of other people's books and just start soliciting them a different way, even electronic, digital text messages. They're going to be able to do that because now they have more time. Because all that happened was you gave them more time. You gave them less enemies to come after them. So, yep, absolutely. The formula for success is easy, but the discipline execution is hard. Yep, I like that. I like to use the word simple because it is basic. It's like 3rd grade elementary shit.
Yep.
The hard part is consistency. See, everybody loves the word discipline. I have discipline because it's sexy. Discipline is consistency for an awfully long period of time that creates a behavior and habit that you drive. But if I said, let's be consistent, people would laugh at me. But if I said, let's be disciplined, people are championing it. It's the same thing, to your point, Ken. But any last questions? I've gone a little over. I do have a meeting that I'm a little late to, but this was a lot of fun. Any last questions anybody has? You should do more events of these. I probably will. Obviously, next time we'll make sure that we get the little code in there so we stay ahead of that. So apologies for that. I will take responsibility for that. And we'll put that all out there. But yeah, there's definitely a lot of subjects that I want to talk to and really put out there because I think it's really needed for the industry. But have an incredible day. As I always like to end a lot of my calls, God bless you and God bless America. Have an incredible, beautiful day, everybody.